Okay, good morning, everybody. Welcome and thank you for joining the session today on blockchain attacks and reorganizations. I'm David Yermak. I will be moderating from NYU Stern, and we will have 3 presentations for 30 minutes. There will be time at the end of each for Q&A, but if you want to ask questions midstream, feel free to put them in the Q&A box, and we will perhaps interrupt as necessary. So the first speaker on the topic of hostile blockchain takeovers is my colleague at the NYU Quran Institute, Joe Bono. So Joe, welcome, and please join and screen share.
Hi, everybody. Okay, shall I start?
Yes.
Okay, great. So thanks for having me. Excited to see this series of talks going on during the pandemic. This was a short paper that I wrote back in 2017, 2018. I should say I'm not an economist, so I wrote this as an 8-page paper with just sort of some thoughts and predictions. I didn't have really a mathematical model of what was going on, just sort of some categorical observations. Although it has actually turned out to be more more cited than anything I've written on the computer science side, where I usually work in the same time period. I guess because it happened to predict some things that have happened since. The question I really started with thinking was just how expensive it would be to disrupt various blockchain systems. So I think at the time, a lot of people were modeling rational behavior and the bar model, and why we should expect these systems to be live, but kind of just asked a simpler question, which was, if you assume an attacker whose goal is to just cause chaos, how much would it cost for them to do so? I wasn't the first person to think about this. There's been this notion of a Goldfinger attack that I believe the term was introduced by Kroll et al. In 2013, so even 5 years before my paper. Of course, it's named after the Bond villain whose plot was to irradiate all of the gold held in Fort Knox. But the meaning in the blockchain context is just an attacker whose utility derives from tanking the price of some asset on a blockchain. So there's a lot of different ways that you could try to do this, that you could try to disrupt a cryptocurrency and make its value go down. The most extreme is to introduce some long fork, possibly overwrite the entire history of the system with a longer fork, or possibly a medium length fork that would allow you to double spend some tokens. But there's a lot of other things that you could do to cause chaos if you had a majority of the network, or in some cases you don't even need a majority of the network, just a large portion, like the classic result on selfish mining, temporary block withholding. Even short of that, there's some things that you could do that would maybe cause less alarm, but still be disruptive, like the notion of monopoly mining. Just mine every block for yourself and reject anybody else's attempt to mine a block. And you could do some milder things like censor individuals or mine a bunch of empty blocks so that nobody can transact in the system. So lots of interesting things you could do. The main question I'll be thinking about, though, is just how you could get to a position to be able to do these attacks, which would require gaining a lot of control over the consensus protocol being used in the system. So I laid out 2 axes for how you would try to get 51% capacity. And capacity could mean different things depending on the system. It could mean half of the computational capacity in a proof of work system, say half of the storage in a proof of storage system, or half the tokens in a proof of stake system, half the stake, I should say. So the 2 axes that I looked at are you gaining this capacity permanently or temporarily? And is it new capacity that you're adding to the system, or are you taking over existing capacity? 4 names, 4 ways to think about this. If you're permanently adding new capacity to the system, I call that building. Think about building a large new mining operation. Whereas if you're temporarily introducing new capacity to the system, you could think of renting. So maybe from an external market like AWS. Of course, now maybe just from the general pool of available cryptocurrency hashing units. But yeah, adding some capacity to the system that wasn't already there. And then if you're taking over existing capacity, you might do it temporarily by what I've called bribing. You could think of this as side payments. Bribe is maybe a value-laden term, but the idea is that you pay existing miners in the system or existing stakers to participate in your attack, to join a coalition with you in exchange for some money, which is more than they would be getting by behaving honestly. Or if you want to permanently take existing capacity, you could think of that as just buying out existing players in the system. Okay, so why was it useful to lay out these different attacks? Well, kind of the first thing that you can notice, depending on the system that you're talking about, some of these attacks are going to be possible and some aren't. So kind of the worst case scenario where all attacks are possible is if you have an ASIC resistant proof of work, which means that it is possible to rent commodity hardware to the attack, and all the other attacks are possible as well. Where if you have an ASIC based proof of work, so think Bitcoin, it's probably maybe a little bit strong, but it's probably much more difficult to rent. There isn't a large excess capacity of SHA-256 ASICs that are just sitting around waiting to be rented that aren't already currently mining Bitcoin. So sort of as a rough approximation, you can say it's not possible to rent a significant amount of capacity to add to the Bitcoin network. Whereas for Ethereum, which uses an ASIC resistant proof of work, it might be, or at least it's much more practical. And for proof of stake, the amount of capacity in the system, the stake is fixed, or at least it's maybe slowly growing. So it's not possible to rent or build. You have to somehow take over existing capacity within the system. So another thing that I looked at is really rough numbers. So I always say when I give this talk, I've dropped a lot of significant figures for a reason. The goal is to just show sort of order of magnitude how expensive attacks might be. But you can run the numbers on how expensive it would be to rent enough capacity to be a majority on different systems. So just looking at Ethereum, I've done this exercise. It's been great since I've given talks every year since this paper came out. Roughly, I've rerun the numbers. Someone actually did an experiment just 2 months ago where they measured the most efficient way to do Ethereum mining by renting capacity on Amazon. So that was great. We have pretty decent numbers now. Basically, for a $3 million an hour bill to Amazon, you could rent enough capacity to be a 51% attacker on the Ethereum network. So that seems pretty low compared to thinking about how much it would cost to build all that capacity yourself. So just looking at different graphics cards on the network, which are typically used to mine Ethereum. And if you look at the number you need to buy, you need to buy millions of these things to get to 51% capacity, and the cost would be somewhere in the billions. And similarly for Bitcoin, you can do the exercise of looking at the most efficient mining hardware on the market, multiplying out how much you need to become a majority miner, and you get a figure that's somewhere in the tens of billions. Of course, you can probably make a lot of objections to these calculations that I haven't factored in the cost of land or buildings, installing all of this. Of course, you're also going to get probably a large discount for buying in bulk when you're buying millions of these things, and you might have access to slightly better equipment. But I would think that the 10 billion is probably within a factor 10 in either direction of the right number. So like I said, I've done this calculation every year, which has been, it's sort of interesting actually to see how, even though my methodology is quite rough, the figures have come out fairly consistent, that it's typically in the few $1 million an hour range to do a rental attack against Ethereum. And it's typically several billion dollars to become a majority miner by building on Ethereum or Bitcoin. It's also been sort of interesting how the costs for Ethereum and Bitcoin haven't been too far apart, even though the market caps of those systems are too far apart. So it does seem that there doesn't seem to be some strict correlation when I've looked at other systems too, that there's any sort of golden rule in the wild for how much it would cost to build out capacity to be a 51% attacker on these networks. And perhaps part of the reason for that is that the market cap can change very quickly with the whims of the market, whereas the capacity that's actually mining on these systems changes much more slowly. Of course, I sort of buried the lead. The most important thing when you see this a table like this, at the granularity of my talk, is just to see kind of the huge gap in these numbers. So, if you think that Ethereum is really worth $200 billion, and it only costs a few $1,000,000 per hour, which is all you'd really need to disrupt the system and probably shave billions easily off of that valuation. You start to get a sense that something seems slightly amiss with these numbers. So I think that's really the right question. Is really what if you think my numbers are wrong? Great. I always love when people work out these numbers themselves and email them to me. But the more important question is really, what value would be enough to make you comfortable calling this $1 trillion system or a $100 billion system in the case of Ethereum. One other note that I always think is worth making, I said that it's not really possible to rent for Bitcoin because there's not a lot of spare capacity that's not mining. The one exception that I think could be interesting, and I haven't really seen explored in detail, is the fact that there is potentially an old fleet of retired Bitcoin mining equipment that's no longer marginally profitable to run. Its profits don't pay for its electricity anymore. But if you're an attacker, that could still be valuable. Particularly because since that equipment doesn't have any marginal profit to run anymore, its value should be pretty close to zero. So you might be able to acquire a lot of that capacity, that old capacity, for a very low price. And you can think of it as it's not really renting at that point, but you could think that you'd be paying for the electricity to run all this old equipment, which would be losing money marginally. But if it gives you, a window to become an attacker, it might be very worth it for you. So I wanted to introduce a new dimension in this talk that I haven't, wasn't in the original paper that I've been thinking about since then, and it's, I guess, preview of ongoing work, which is the difference between computational puzzles that have high and low operating costs. So I've sort of already made the claim that dedicated hardware is better than ASICs because it takes away that rental market. Also has a nice property that if you destroyed the system, if you destroyed Bitcoin by acquiring lots and lots of ASICs, they would lose a lot of value. There's kind of a second dimension though, which is that ideally, if you were designing a system, the equipment would all have very low operating costs. And the reason is that those are non-recoverable. So all the electricity that Bitcoin miners have spent to date mining, that's all expenditure that's gone that the attacker doesn't have to match if an attacker is building 51% capacity, right? They only have to match the capital cost, but not all of the wasted energy that's happened so far. So now I can introduce another two-axis system based on this. Platforms that use dedicated hardware, ASICs, versus commodity hardware, and ones that have high operating costs versus low. So Bitcoin, conventional SHA-256 proof of work, high operating cost, uses a lot of electricity, and uses dedicated hardware. And something like Ethereum with memory hard proof of work uses commodity hardware, but also has high operating costs. Now, there is a family, proof of storage, proof of space, of different projects that are designed to have low operating costs. They mostly run on commodity hardware so far too. So that's good in a sense, that, as I said on the previous slide, it's better to have, it's better from the point of view of it's worse from the point of view of an attacker taking over the system if it's something with low operating costs. But those all run on commodity hardware right now as well. So there's kind of a missing quadrant of this, which I don't really know of a good example of. Get in touch if you think I'm missing something here. People have suggested that proof of stake is sort of like this quadrant, but I think I think proof of stake is really something different. People have suggested that proof of elapsed time, which uses trusted execution environments, can sort of be dedicated hardware, but with low operating costs. That also introduces a lot of different assumptions. I haven't really seen a good example of something that hits this quadrant, which is kind of ideally where you'd like to be if you're doing, I guess, a non-proof of stake system. Okay, but back to this axis, let's switch and look at the bottom half here and think about bribing and buyouts. Not going to talk about too much about bribing. There has been a lot of work on this since another paper that I wrote in 2016 about different ways that you can transfer money to miners and try and get them to do your bidding. People have looked at this a lot now. There's a new term that didn't exist when I wrote the paper called miner extractable value, or MEV, that you might have seen written about in places, which is just the notion of putting money that's free for whoever mines the next block to take on certain branches of the chain, which could be a way to get miners to favor one chain or another. So I'll just say that there's a lot of ways mechanically that these bribes could be carried out. And thinking about how much you'd have to actually do, the key metric is how much revenue miners are making in the system, which is now in the millions of dollars per hour. So in theory, if you just bribe miners more than that, if you offer them 2 million plus epsilon, then they will be making more money, doing your attacks than they would by honest mining. So they should participate. Of course, that's really very simplified, but again, the interesting thing is just how much lower this value is than the market cap of the system. So the big question is, will miners actually go for this? Has this happened in the wild? I don't actually know of any cases where it has. And it's kind of it's an interesting situation for miners because it's in, it's bad for the system. It's bad for their long-term interest if miners take these short-term bribes to make a few extra bucks, but they damage confidence in the health of the system. But of course, for individual miners, if they figure they can take the bribe and the attack might not even succeed and they can make more money, it's in their interest. So, I identified this as a potential tragedy of the commons, that bribery, or, you could think of these sheep as grazing on that MEV. It's something that they all hope everybody else doesn't do, but is in everybody's interest to do in the short term. And the last quadrant to talk about is a buyout. What would it cost to pay off existing Bitcoin miners to take over their capacity? There isn't really a great way to answer this question besides thinking about what the net present value of all that Bitcoin mining capital is to the owners. Which is it's very hard to estimate because the price of Bitcoin has increased so much in the last year. One thing I noticed it's pretty interesting is that the total revenue that Bitcoin miners have earned in history is about $10 billion. The value at the time that they earned it. Whereas at the current rate, they're expected to earn $20 billion in 2021 alone. So it's very interesting that every year is basically worth more than the entire history of the system when we have exponential growth like this in the price of Bitcoin. The one other interesting observation about this, though, just comparing a buyout to a building attack, whatever that net present value of all the Bitcoin hardware is, you only need to pay half of it. And the reason, well, of course, since it's a 51% attack, if you're buying out, sort of every unit that you buy is more for you and also less for the rest of the network. So you get this sort of like factor 2 boost to the attack. I think the one other interesting thought experiment in my paper was thinking about what it would take to do a buyout in a proof of stake system where you need to acquire a majority of all the tokens, and noticing that the dynamics might be a little bit different here. And the reason is that once you threaten to buy out, once people think that you might be serious about doing this, that could have huge price impact on those tokens that you're trying to buy. So there's, I guess we have a lot of economists in the audience who probably know more than this, more about Black Wednesday than I do. But I know this is like one historical example of this happening. The way it might play out in a cryptocurrency is that some large player with, they need to demonstrate that they have a lot of capital to make this threat serious, would threaten to do a buyout where they buy out, basically half the stake in the system with the purpose of destroying it. As soon as they're able to demonstrate this threat, the failure of the system gets slightly more likely, and that means that more stakeholders are going to want out of the system. If there's a higher probability of it failing, the price is going to go down. And if you're lucky, if you're an attacker, you can get kind of a vicious cycle for the system going, where more and more people think the system's going to fail, the price keeps going down, and your attack gets cheaper. And the sort of interesting part of it is that you only have to get to 50% or 51% to destroy the system, or at least cause pretty serious havoc. And the stakeholders who don't sell are going to be left with nothing if your attack actually succeeds. So haven't seen this play out in practice, but this is my prediction in the paper that this could someday be used to take one of these systems down. So I guess I should say, I don't want to take too much credit, because I predicted a lot of things in the paper were possible that didn't actually happen. But the one thing that did happen, kind of eerily close after I published the paper in 2018, is that we started seeing Goldfinger attacks in practice, specifically, as far as I know, rental attacks. And I do think multiple other people were thinking this at the time, or were sort of warning that this might become a phenomenon, and pointing to some factors that were making these attacks more likely. In particular, just the fact that the rental market was maturing then in 2018 to the point that it could actually be used to mount attacks. And sure enough, we've had lots and lots of rental attacks starting in the spring of 2018. I think the first recorded one was about 2 months after the paper came out. And we've seen lots since then. And there was even, there have been so many actually, including on bigger and bigger systems like Litecoin, Ethereum Classic. There's actually been a project at MIT to track these. And they successfully correlated some of these attacks happening with spikes in the rental prices on the NiceHash network, which provides pretty good evidence that this NiceHash rental market is actually being used to mount these attacks. So, kind of the classic rental attack where you go to the rental market, rent 51% for a few hours, and fork the chain, seems to be happening in the wild. In terms of countermeasures, they're pretty tricky. There's kind of the in-band countermeasures of some coalition of the good guys or the victims of the attack renting or building more capacity themselves. I predicted that this would be difficult because it's a collective action problem for everybody on the network. Although interestingly, there has been some evidence that this has happened in practice too now. So that's been pretty interesting to see. then there's sort of the human level countermeasures of, the administrators of the system, the adults in the room theoretically stepping in and saying, an attack has happened, so we're going to manually fork the chain to undo the damage of the attack, which certainly can happen. It's just expensive to do repeatedly. Certainly to the credibility of the system, it's expensive. So that's those were the sort of general ideas from the paper that I wanted to talk about today. And I know that we have 2 talks following me up. They're going to talk a lot more about what these attacks look like in practice that I'm looking forward to hearing. But I'm happy to take questions now before those talks if anybody has any.
Thank you very much, Joe. And those of you who would like to ask questions, please use the Q&A box. I will then unmute. I would just remark that learning about the NiceHash system and the availability of it is what led me to organize this session today, in fact. And I'm a little surprised that other people have not entered the market alongside NiceHash. So Harold Lulig has the first question, and if you give me 1 second, Harold, I will unmute you. So please go ahead now.
Yeah, thank you, Joe. I mean, this is a really interesting talk. I'm interested in this last slide that you put up here on the countermeasures. So thinking about Bitcoin, for example, right? I mean, the way the system is set up, it looks very mechanical. You're always supposed to extend the longest chain and so forth, right? But I mean, it's interesting that we talk about attacks at all, even, right? Attacks mean that it's widely known that this is an illegitimate attack, right? That somebody is trying to break the system, whatever, right? And so in principle, all miners that are part of this understand that an illegitimate attack has just happened. And it would seem to be, and they stand to lose out on this. I mean, they don't want that to happen. Their livelihood depends on that and so forth. So even if the attacker is successful and extends that chain and becomes the longest chain, it seems easy, right, for the other miners to say, well, wait a second, why don't we just continue this other chain? Eventually, we're going to have the longest chain and restore consensus this way. I understand that this isn't part of the mechanics of how this works, but I just wonder how easy it is by basically, agreement to continue to do this. And that would seem to be a cheap countermeasure.
Yeah. Well, I'm not sure it's cheap because I guess it depends on how the attack happened, but presumably the attacker had a huge mining capacity, so it's not like totally trivial to overcome their fork, unless it was a rental attack and they no longer have that capacity. But it's still a collective action problem where all the miners have to agree to switch from the actual longest chain to a shorter chain and extend it. And there really isn't anything built into the protocol for that to happen, right? So this would require miners talking out of band, getting on the phone or on forums online and deciding to make this switch, kind of reprogramming what they're doing. And they have to believe that everybody else is doing it too, because if only 40% of miners decide to do this, then they're just going to be wasting their time on a shorter chain for a while until they realize that, they're not going to actually undo the attack. So it's definitely not impossible. It's just, it's not something that at the level of Bitcoin that we've seen happen in practice so far.
We'll take one more question from Jeffrey Zheng. Go ahead.
Hi, can you hear me?
Yes.
Yeah.
Okay, perfect. Thanks, Joe. That was really interesting. I had a question sort of stepping back a little bit. It's true that an attack could harm the value of Bitcoin or Ethereum a great deal. But when we think about incentives, it seems important to think about how profitable the attacker could find doing the attack. So, if I tank the value of Bitcoin, maybe I hurt everyone else's value of Bitcoin, but I haven't enriched myself personally. So what would be a realistic use of, let's say, 1 hour of a 51% attack that would let me profit a great deal personally?
Yeah. So I think like the 2 models are either you have a big short position on the price of that asset, which is becoming more practical as there's more mature derivatives markets for all of these different coins. So that's one way you could profit, is using this attack to cover your short cheaply. The other way is just doing a huge double spend, right? So that potentially almost has like a unbounded profit if you're able to sort of spend some money and then get the money sent back to yourself. And that might only take an hour depending on people's confirmation times, or a couple hours. So I think those are the two paths. That there's some friction on each of them. It's not like you can sort of make infinite profit, but yeah, I mean, it's sort of interesting that the double spend works even if the market kind of yawns at your attack and there isn't very much price impact of seeing a huge fork. You could still make money by double spending if that's what you do.
Joe, thank you very much. I'd like to move now to the next presentation, which will actually address this issue of double spending very directly.
Great.
So the second paper will be presented by Sava Shanayev. Sava has a paper already published on this, but he has kindly updated the data set to make it very current. So this is very interesting event study on 51% attacks. Sava joins us today from the UK. So please go ahead. Thank you.
Welcome, everyone, and many thanks for having me here. So my talk is titled Cryptocurrency Value and 51% Attacks, Evidence from Event Studies. And it's kind of a basic empirical finance paper that I've written long time ago, actually, in November 2018, and published it a year after in Journal of Alternative Investments. But while it was in the first stage of revision, I have surprisingly seen more and more 51% attacks happening. And it was, first of all, troubling for me as a cryptocurrency enthusiast myself, but it was kind of reassuring that the topic of my paper was actually relevant. And actually, it is more and more evident that is more and more relevant nowadays as 51% attacks become kind of more and more prominent, and they become a reality as the cryptocurrency market matures. So this is basically an event study of an as exhaustive as possible sample of 51% attacks. So let's start. And here is the quick outline of what we're going to do today. So theoretically, the researchers and the blockchain enthusiasts were thinking about 51% attacks, how likely, how harmful they can be since at least 2013. And the earliest paper already been mentioned is Kroll, Davey, and Felton, 2013. And what Kroll et al. Suggested is that attacks are theoretically possible, but they are very improbable. And if they are ever executed, they are not motivated by selfish financial on-chain motivation. So for example, double spending or the likes of that. They need to have an external selfless motivation. So you could think organized crime group that just wants to sabotage Bitcoin or Ethereum or whatever. It could be a government agency who just dislikes Bitcoin because it can be used for money laundering or tax evasion and the like. Or they could be motivated by ransom. And that's ransom motivation is actually what led the first historical 51% attacks. So basically, Kroll concluded that attacks cannot be selfishly motivated, at least with an on-chain financial motivation, and they need to be motivated out of chain, either like a selfless motivation, think terrorist group, an organized crime group, or a government, or an out-of-chain financial motivation like ransom. And there has been discussion going backwards and forwards in the literature about which types of blockchain, which consensus algorithms, which hashing algorithms, if we talk about proof of work, are less or more vulnerable to these selfless attacks with out-of-chain financial motivations. So for example, one of the earliest papers on that is Howie 2014, who argued that proof of stake is more vulnerable than proof of work to such externally motivated attacks. And there has been a lot of developments since. And the early concerns in this tradition were that mining pools can become a problem. As early proof of work industry has matured, due to the fact that miners are risk averse, as all people are, according to basic finance models, it's better to receive a fraction of a Bitcoin every couple of blocks than a whole Bitcoin every couple of thousand blocks. So guided by self-interest, miners were organizing themselves into pools, and it could be feasible that a pool could grow to more than 50% of hashing power and thus orchestrate an attack. However, the two very important deterrents that Kroll et al. Actually compiled together prevented mining pools from becoming a real problem. First of all, there is a need for a large sunk cost if you want to organize the attack, and that actually nicely translates to the build attacks outlined by Joe earlier today. If your hashing algorithm, for example, in proof of work is coin specific, then you need to buy a whole lot of assets, invest a lot of money, and then after you have successfully attacked the blockchain, it has been compromised and no longer functions, this investment is worthless because, well, it's application specific. You can no longer apparently mine based on these bits of hardware. And also, as a financially motivated 51% attack derives its main financial gain from double spend, as it's not easy to short crypto assets even at that stage, especially small coins and obscure coins, you receive the payoff from double spending by getting the very coins of the blockchain you've just attacked, which is compromised and the value plummets. So the attack is basically self-defeating. So mining pools restrain themselves from getting more than 50% attack, and they even got agreements in place that limited their maximum share of the hash rate. So these concerns didn't come through. And actually, as I already kind of hinted, early attacks on proof of work blockchains in 2012 and 2013 that are the first records we have available, and those were three unfortunate blockchains, Coiled Shift, and Krypton. Attacks on these were consistent with the theory. For Coiled, it was just a disillusioned former enthusiast who attacked the blockchain out of selfless, out-of-chain motivation, and Shift and Krypton were ransomed. So the developers of those blockchains were ransomed, and they just said, well, either you pay us or we just attack and disrupt your blockchain. So they both had, all three of them had out-of-chain motivation. So seemingly, Kroll et al. Were correct, and nothing hinted towards 51% attacks that are financially motivated and thus can be executed on larger scale, wider scale. It seemed improbable. However, in 2018, their number just exploded. So what has actually changed? Well, here you can see a table with the exhaustive sample of 51% attacks that were successful, so that could take over the chain for at least some time. So I don't include unsuccessful attacks here. And there were 29 attacks from the start of blockchain's history until start of March. So I have revised this data set from my first version of the paper. In the first version of the paper, I had 14 attacks. So we can already see that attacks are quite prominent. There were only 14 attacks from 2009 until 2018, and 15 more attacks happened from the end of 2018 until today. So it kind of verifies the main point that attacks are becoming more and more common. And we can see that some of these attacks are still not financially motivated, as they do not result apparently in double spend amounts. So where losses are zero, those are either selfless attacks or attacks that are executed based on the out-of-chain financial motivation. However, more and more of these attacks with time become financially motivated and trigger double spending rewards for their attackers. And we can see that if we just calculate simple price returns on the day of the attacks, all 29 coins, albeit to different extents, are affected negatively by these attacks. So the market knows that the effects are there and that the attacks are harmful for the blockchain. Well, that's quite straightforward and unsurprising. However, we can use event studies to generate more nuanced inferences from this data, especially as we have got 29 coins already, which allows us to undertake more nuanced analysis as we go. So this is the dynamics of 51% attacks over the years. As we can see, there has been a large peak in 2018 with more than $20 million successfully double spent in those attacks. So in 13 attacks, more than around $21 million was double spent. It was relatively quiet in 2019, but attacks were still taking momentum in 2020 with almost $14 million double spent. And in less than 3 months of 2021, at the time of recording, more than $2 million were already double spent on various blockchains in 2021. What we can also see is that the average loss per attack, so the harm that is caused by one attack in dollars at least, grows with time, which is perhaps unsurprising given that the cryptocurrency market cap evolves and increases exponentially with time, but still it can serve as an alarming observation. So the stellarest facts about 51% attacks in the wild are that the early attacks were non-financially motivated, or at least motivated financially out of chain, think ransom. Our latest attacks were almost exclusively financially motivated, so something changed. Early attacks were very sporadic and targeted individual coins, while latest attacks focus on a small range of coins that are most vulnerable. So for example, you can see from this table that three coins that are Bitcoin, Gold, Ethereum Classic, and Verge were attacked 3 times each. So there are serial victims of 51% attacks, if you want to call it that way. Attackers increased their activity in 2020 and early 2021. And if we try and speculate what are the reasons for it, then it's quite apparent. The first reason, which I have got over here, and it was already touched upon by Joe, is that hash rate no longer provides this sunk cost deterrent, as you can use platforms such as NiceHash to rent hash rate, temporarily taking control over the chain, and not having the sunk cost component that deterred attacks successfully before the market matured and hash rate became rentable. And second reason, and I would suggest that this reason is at least as important as the former, and very often overlooked, is that ASICs, application-specific integrated circuits, are no longer coin-specific. There has been a lot of hard forks happening over the years, and for example, coins that use SHA-256 algorithms are not unique. It's not only Bitcoin now. There are lots of smaller coins that use the same algorithm. So you could potentially purchase or rent loads of hash rate, loads of ASICs that operate on this algorithm, successfully attack a small coin, and then continue to mine Bitcoin as if nothing happened. So these two deterrents no longer work. However, what happens to the deterrent that, well, you double spend coins from the chain you attacked? We see that prices drop quite massively. Doesn't that deter attacker activity? Well, we'll see what happens with that just in a moment. And now we'll proceed to studying the event study results with the simple pseudo portfolio methodology. So what is pseudo portfolio methodology? It is basically quite a simple and insightful, but yet insightful technique from empirical finance, where you form a quasi pseudo portfolio of coins based on the number of days before they got attacked. So here I have got an equity curve, so just cumulative or buy and hold return dynamics for an equally weighted and a value weighted portfolio of all coins from my sample starting 31 days before the attack was recorded, and see how the dynamics of buy and hold and normal returns evolves through time. And we can see here the dash dotted line represents day 0, which is the day of the attack. And what we can see here, which is quite surprising, is that, well, first of all, quite obviously, the price tanks substantially at the event day, at the attack day. And the magnitude is around 10% on average, regardless of what methodology you use. Regardless of the model, you can use the constant return model, the market adjusted model, CAPM, you name it. You'll consistently get an abnormal return of around minus 10% on the attack day. But what is more surprising is that you have got seemingly unexplainable positive price movement roughly starting 5 days before the attack itself. And that hints towards what's going on with the second deterrent to 51% attacks. Because you can, especially if a coin is small and illiquid, and those are the types of coins you would attack using rented hash power or hash power that is convertible to mining a bigger, more prominent cryptocurrency, those coins are illiquid. And it means that you can easily combine a 51% attack, hardware blockchain attack, with a market pump and dump attack. You can just accumulate coins prior to the attack, influence the price, manipulate the market. And when you attack, you start collapsing your pump and dump scheme, releasing the stake of coins you have accumulated either by buying them and by double spending them, making a hefty profit in the process. So this is the insight that made the attacks so profitable. It's simply because you could manipulate the market and manipulate the blockchain at exactly the same time and get a financial reward while being rationally motivated, not needing to ransom blockchain developments anymore, or being affiliated with the government or organized crime. However, what is different here to my initial paper is that given the fact that I've got 29 coins, I can do some robustness test and see whether the effect is homogeneous or heterogeneous across different coins. I have separated the pseudo portfolio across original hashing algorithms. These are proof of work coins that are the largest at the moment of the attack, utilizing a particular hashing algorithm. So for example, Bitcoin would be the largest proof of work coin utilizing SHA-256. And there are coins that are very small but original, and coins that are very large but unoriginal, Bitcoin Cash being quite large but unoriginal, using the same algorithm as Bitcoin does. So we can see that in all various methodological approaches, the unoriginal hashing algorithms suffer more from the 51% attacks. And what is going on here is actually that they do not recover at all after the attack, collapsing further and further down after the event day. While the original hashing algorithms, first of all, have more pronounced pump and dump schemes associated with the attacks, but they do recover quite seamlessly after the attacks go on. And that means that original hashing algorithms potentially provide some protection against such new selfishly motivated, financially motivated attacks. And you need to execute quite a tremendous pump and dump scheme before to get at least some financial reward out of such an attack. However, this finding is still quite in its infancy. So more tests need to be made before something can be said along these lines with reasonable certainty. And here there are the results combined into a table with the significance tests and tests of cumulative abnormal returns across various event windows. So it verifies the fact that there are significant negative abnormal returns on the day of the attack, and there are no positive corrections overall after the event. So there are some negative significant results, but not much positive significant results, only over here, but it's counterweighted later on down the line. However, there are significant positive abnormal returns almost in all estimations before the attack, starting roughly 5 days prior, verifying the notion that 51% attacks are being accompanied by pump and dump schemes. Same is pronounced with buy and hold abnormal returns, similar to cumulative abnormal returns. And a similar finding can be established with panel regressions instead of pseudo portfolios. So I wouldn't focus on that too much. This is just robustness checks using different empirical finance techniques and estimation algorithms to test for result robustness. And here are some stylized facts. We have obtained some key findings that I wanted to focus on. First of all, the attacks do robustly reduce cryptocurrency value by around 10%. The attacks are preceded by positive, cumulative, and buy and hold normal returns, starting roughly 5 days before the attack, which means that attacks on small illiquid coins are being accompanied by pump and dump schemes that increases potential payoffs of the attackers. Coins do not recover to pre-attack values even 10 days after the event. 24 out of 29 coins were trading lower at day plus 10, so 10 days after the attack, than at the start of our estimation period. I also wanted to reinforce again the observation that attacks are becoming repetitive, with some blockchains like Ethereum Classic, Bitcoin Gold, and Verge becoming serial victims. And quite interestingly, this observation can hint towards what is going on with the current bull market. The most recent bull market episode of 2017 was associated with an explosion of altcoins and small cryptocurrencies, with Bitcoin dominance decreasing as the market capitalization, total market capitalization was increasing. So at the very peak of the 2017 bubble, Bitcoin dominance was around 40%. Now the market is also in a bullish stage, but Bitcoin dominance is increasing. And that can actually explain what happened, simply because the market now understands the risks that are associated with small coins with low hash rates, and more market participants become Bitcoin maximalists. And what it can also be found from some other tests that I made on hashing algorithm heterogeneities is that original hashing algorithm coins are more resilient. To profit on them, attackers have to orchestrate massive pump and dump schemes alongside that. And not only that, original hash rate coins recover very fast after the attacks. So to conclude what I was just presenting, the attacks that I was talking about and Joe was talking about before obviously pose a significant threat for cryptocurrency investing. Reconsidering, rethinking Kroll et al. 2013, they are no longer impossible or improbable. They are most certainly the norm. Around 10 attacks happen every single year. And in 2021, if we project what's going on in the first 3 months of the year, we can see 2021 even overtaking 2020 and being more like 2018 in 51% attack prominence. The 51% attacks are most relevant and most risky for proof of work coins with extremely low hash rates, especially if there exist more prominent coins that use the same hashing algorithm. The reason for the attacks becoming more prominent is that hash rate has become rentable via platforms like NiceHash, and thus the sunk cost deterrent is less effective. The other reason is that the markets for smaller coins are illiquid, and you can make an attack more viable by combining the attack with a pump and dump scheme. And what does it mean for investors and for blockchain developers, most importantly? Well, first of all, you should not fork without a very good reason, because if you fork from the large cryptocurrency and maintain the same hashing algorithm, you just wave at the attackers and say, hey, you can attack me and then mine the larger chain. You should not do that without a very good reason, without a very good technological solution. So here we see that there is a negative externality for the market at large from ill-thought hard forks that maintain the hashing algorithm of the original chain. And also what can be important is that hashing algorithms need to become coin specific for the market to become stable and 51% attacks to become less prominent and more preventable. And I think that's a good place to stop and move on to question and answers.
Thank you very much, Sava. The first question is from Jacob Leshno. So please go ahead.
Yeah, hi. Very interesting. Thank you. So one thing that's like seems in your graph is like that prices go down by about 10%, which seems on trend. And 10% is not abnormal for like cryptocurrency returns. So I found it a bit surprising because like the view that like the tax will destroy value seemed to me like it will destroy long-term value of the coin. It's not like that the price decreasing the next week. It's like that the system will just collapse and will never recover. Any thoughts of this? What do you think about the long-term trends of effects of an attack?
I just would like to add, I'm surprised it's only 10%. It seems like it should be bigger.
Right, so excellent question. What I can say about that is that, well, on average, the negative effect of a 51% attack is permanent. So coins do not recover to pre-attack levels in reasonably long time windows after the attack. So it is permanent. Obviously, 10% is not a lot for cryptocurrency markets, really. So potentially, it could signal that low hash rate proof of work coins have a lot of 51% attack risk already priced in before the attack happens. So this is accounted for probabilistically. So a coin with a low hash rate could not potentially appreciate that much. So when the attack happens, investors just probabilistically adjust their valuations, and they kind of forecasted the attack before with some notion of it. But the effect is permanent. It is statistically significant, even for a cryptocurrency market, with a t-stat of around 4.5, which is nothing to shun at. Obviously, it's not the whole impact, it's just the realized impact. To understand like what is the total impact, we should have known what is the kind of implied probability of a 51% attack on a cryptocurrency, which requires more technically advanced analysis. But a good comment overall. Thanks, Jacob.
Yeah.
Thank you. We have one more question from Harold Ulig.
Yeah, I mean, super interesting. I mean, you documented, I mean, it's great to see this data analysis. You documented that attacks are more prominent for proof of work coins with low hash rates.
Mm-hmm.
What we may be ultimately interested is more the economic damage rather than just a number of occurrences. Do you have a sense whether there's a sweet spot, or is it the coins with a particularly high market capitalization where the largest economic damage happens? Can you say something on that?
Right. So in terms of quantifying the economic damage of it, the total economic harm, like amount double spent, amount stolen, is roughly $40 million across the years, with most of it being in 2018, which has been the 51% attack extravaganza at that point in time. In terms of figuring out which cryptocurrencies are more likely to become targets, well, it is it is interesting to think about it. However, we have got only like 29 episodes, which is enough to do event studies analysis like mine, but can be quite not enough to do, for example, probit regressions, logit regressions to figure out like propensity matching algorithms to figure out what characteristics correspond to a coin being likely to get attacked. As if I'm correct and more attacks are on their way, then in a couple of years I'll probably publish a paper on that. Or there is some other method that you could use to forecast which coins are more likely to get attacked. But again, it's just a good suggestion for further research. Haven't looked into it too much, but thanks for the suggestion. Thanks, Harold.
Sava, thank you very much for the presentation. We're going to move now to the third speaker today. Klaus Grobis is joining us from Finland, and his topic is on the tail risk of cyber attacks in the Bitcoin market. So welcome, and please go ahead.
Yeah, hello and welcome also from my side. My name is Klaus. I'm Assistant Professor of Finance at the University of Vaasa and Adjunct Professor of Economics at the University of Jyväskylä in Finland. Thank you to David for inviting me so that I had the opportunity to present my latest research paper here. And the paper is entitled "On the Tail Risk of Cyber Attacks in the Bitcoin Market." So I would just briefly like to introduce you to my team. One of my co-authors is Josephine. She's a doctoral student in mathematics, and her interests are stochastic volatility and ergodicity structures in data. She's also interested in the housing market, actually. Then I have also Niranjan, who is a doctoral student in finance. I'm actually his second supervisor, and his interests and specialties are in fintech and token ecosystems. And yeah, he's a very smart guy, and we have many projects together. And he's sort of fintech Wikipedia. I sometimes call him like that because he knows basically everything. This is his passion, yeah, and he will be the first doctoral student who will graduate with a finance degree that is specialized in fintech. Yeah, so is Bitcoin a positive black swan? So in one of his Google talks, if I'm not mistaken, Nassim Taleb referred to Bitcoin as a positive black swan. So if we go back to 2010, the value of a single unit of Bitcoin was back then $0.0008. And now we know that it's traded around $60,000. So if you had invested only $1 in Bitcoin back in 2010, you would be now a multi-millionaire. Yeah, you would have now your net worth in Bitcoin would be 62.5 million US dollar. So Nassim Taleb was right. Obviously, this Bitcoin is sort of a positive black swan in terms of its payoff if you consider this 10-year period. But there's also a dark side of this positive black swan. So let's talk about the risk of money laundering. So this research shows that cryptocurrencies became the currency of choice for many drug dealers because of the opportunity to hide behind the presumed privacy. In another study recently published in the Review of Financial Studies from Foley, Carlson, and Putnins, they document that about 1/4 of all users and close to 1/2 of Bitcoin transactions are associated with criminal activity. So that was the risk of money laundering. Let's talk about default risk. In my own research that I conducted with Niranjan, we examined all available 146 proof of work based cryptocurrencies that started trading prior to the end of 2014, and we traced back their performance until the end of 2018. So we considered it a 4-year period. And obviously back then in 2014, there were only 146 cryptocurrencies that had the proof of work consensus protocol. So what we found is that 60% of those cryptocurrencies ended up in default, which brings us to the risk of price manipulation. The recent research shows that suspicious trading activity in terms of cyber attacks is likely to have caused the unexpected spike in the US dollar Bitcoin exchange rate in late 2013, when the rate jumped from around $150 to more than $1,000 in just 2 months. In another study, it is documented that purchases with the stablecoin Tether are timed following market downturns and result in sizable increases in Bitcoin prices. So the study published in the Journal of Finance actually last year, the results of that study indicate that unbacked digital money inflates cryptocurrency prices. So that was the risk of manipulation, which brings us to the risks of cyber attacks. So in my own research, I explored the impact of 50 Bitcoin hackings on the volatility process of Bitcoin, and I found in this study 2 effects. So the first effect is that Bitcoin volatility, unsurprisingly, increases on the day when the hacking attack takes place. And then it goes down again to more normal levels. And then on the 5th day, it spikes again. Yeah? And what is interesting, I also investigated the impact of Bitcoin hackings on Ethereum. And what I found is Ethereum is not responding on the day when Bitcoin is attacked, but on the 5th day. Yeah? So if you want to earn some money, then obviously you wait a couple of days after the hacking incident took place, and then you buy a straddle, and So that was a recent study that is published in Quantitative Finance, and that study that I would like to present here, that is positioned in this stream of research. Yeah? So it's related to investigating the risk of that is related to these new digital ecosystems. So what's the problem? So the problem is that during the 2011 to 2018 period, there occurred 53 hacking incidents. And in these 53 hacking incidents, 1.7 million units of Bitcoin have been stolen. So what's the current supply of Bitcoin? Actually, I don't know. I only know that the maximum supply is, I think, 21 million, and that will be obviously achieved somewhere in 2150, I don't know, in 100 years from now onwards. So nowadays, I guess the supply is between 17 and 18 millions of Bitcoins. So obviously about 10% of all Bitcoins have been just stolen. So the monetary equivalent is exceeding 655 million US dollar, which clearly highlights the societal impact of this criminal activity. Naive risk management may dramatically underestimate this risk. And what we do is we examine the distribution of hacking incidents and build a statistical picture of their tail properties using a very recent methodology proposed from Carrillo and Taleb that is related to extreme value theory. We compute the estimated expected risk, and we argue that our study has some important implications for policy makers. How do we contribute to the academic literature? Well, if we take the view from the broader audience perspective, our paper extends the literature on exploring to which degree social matters are exposed to tail risk. One important study here is this from Clauset, Schelitzy and Newman, the 2009 paper, where they investigate 24 real-life data sets and fit power law distributions to that data. A very, very interesting paper. I can highly recommend to read that paper. Then from a more narrow audience of finance researchers, our study adds to the literature on financial markets using power law distributions for model financial data. A good overview is given in the paper from Lux and Alfarano. Then from the perspective of the audience of crypto finance experts, our study contributes to the fast growing literature on exploring new emerging digital ecosystems. And as you see here, the strand of literature is getting larger and larger because it's an interesting topic. What is our methodological approach? You see here a picture of Nassim Taleb in his new book that deals with pre-Assam topics. He argues quite clearly that power laws should be the norm. And the Gaussian normal distribution is just a very, very special case that in real life obviously doesn't exist. So first, what we do is we start by using various tools to diagnose the fat-tailedness of the distribution of Bitcoin hackings. And what you see here on the left side, you see the mean excess function, and you see a linear trend, upwards moving trend, which is a clear signal for fat tails. Yeah? So we also do many different other stuff in that paper, and all points towards that this process is heavily fat-tailed. So you see here on the right-hand side, we see the hill plot. Yeah? So we see that the optimum for the power law exponent is defined by the minimum value of $1.1 million per attack and exponent, power law exponent of 1.62. So this vector minimizes the Kolmogorov-Smirnov distance of the data. So next, we employ the same method as recently proposed or used in the paper from Grillo and Taleb from 2020 published in Nature Physics. They investigate the risk for contagious disease such as COVID-19. And this approach relies on extreme value theory to compute the shadow mean, which is something that we do not see from the steering on the data. So we have to get it out of the data. The rationale of this approach is that, first of all, not more than the whole Bitcoin supply can be stolen. And it's the same logic as argued in the paper from Grillo and Taleb. Obviously, not more than the whole population on Earth can be a victim of a pandemic. Only all people can die. Not more than the whole population of people can die. And in the same logical manner, not more than the whole Bitcoin supply can be stolen, which is a low probability event, but which most likely never takes place. But it's the probability is not equal to 0 either. And second, it can be shown that the extreme values of any distribution follows a generalized Pareto distribution. So the whole procedure involves a 7-step, and it's detailed in our study. But the question arises when dealing with power laws, what threshold should we choose? In empirical finance, people usually consider like 5% of the largest values of the distribution and then fit their model. In the paper from Grillo and Taleb, they allocate 34.7% of victims in the extreme value category. We use $1 million, and why? Well, because that's the optimum, defining a distribution that has no mean, as we see here in the previous slide. So 1.62, that's, if we have a power law exponent of 1.62, that's a distribution that has no variance, no kurtosis, and no mean. So that's the distribution what we have to deal with. So we work with dual observations like Grillo and Taleb, using $1 million as threshold for extreme hacking incidents. And what follows is that we allocate 41.5% of the observations in the extreme value category. Next, we fit the generalized Pareto distribution. We get the parameters Xi and beta and sigma, and all of the parameters are significant on a 5% level. So we get a shadow mean, and the shadow mean is about $60 million, which is almost twice as high as the corresponding sample tail mean, which is roughly $30 million or $31 million. We then have to combine the mean below the threshold and to get the overall mean, and the overall mean of the data is around $25 million. And if we take just the naive sample mean, that's 12.36 million. So if our approach shows that the risk is almost twice as high as we would get when using just naive statistics to compute the risk. A brief discussion here on that paper. In Grillo and Taleb's research, the shadow mean using actual data is about 1.5 times larger than the corresponding sample tail mean. The reason for why our results suggest a much stronger effect of the shadow mean than documented in their paper is that our upper bound exceeds the one in their paper by a factor of 15. Moreover, our results strongly support the argument in Grillo and Taleb, namely that the naive use of the sample mean would be misleading and would result in a substantial underestimation of the risk. We also use a goodness of fit test as outlined in the paper from Clauset, where under the null hypothesis is that our data follows a power law process, And our p-value of 0.24 suggests that we cannot reject the power law null hypothesis. We also use different upper bounds. Yeah, so we also replicate our study using the maximum Bitcoin supply. We also estimate, we also restrict the sample and use just a certain subset of Bitcoin hackings. And our results are robust to any change that we impose. To conclude, well, new digital financial markets based on blockchain technology offer various benefits such as user autonomy, discretion, peer-to-peer focus, lower transaction fees, and international payments and accessibility. We know that. However, we have seen that we also face some new types of risks. While earlier studies explored the volatility risk or the credit risk in cryptocurrency markets, the novel aspect of that study is that it explicitly explores the risks of hacking incidents in the Bitcoin market. We use a very recently proposed approach based on extreme value theory and show that naive statistics dramatically underestimate the expected risks associated with Bitcoin hackings. Our results underline the urgent need for cryptocurrency market regulations from governments and regulatory agencies. Yeah, thank you for your attention.
Thank you very much, Klaus. And we do have some time for questions. And we still have the other two speakers with us, of course. And so I would open it up to anyone who would wish to ask a question to any of the three. I was a little surprised by your last conclusion, though. I wonder why you would think that government regulation would be helpful here. You know, why is that implied by the analysis that you've done?
Yes, somehow it needs to make one needs to ensure that the that it can be traced back, that the incentive to steal from other people's wallets is somehow lowered, or that there's some, I mean, because there's a lot of money that's basically stolen, and one needs to protect the investor. So it's about investor protection, basically.
I see. Okay. So Jergo, you have your hand up. Go ahead, please.
Yeah, thanks. So, I have two questions. One to Klaus, the other to the previous speaker, Sava. To Klaus, can you do your estimation based on different time period, or does maybe you can't just because you're asking a full sample question? But to me, you know, the different stages as we see the previous paper seems like very important distinct characteristics to say that whether you do have this type of attacking risk. For the previous Sava, I'm trying to wrap in my mind on how does exactly that attacking itself can create money, can make money if there's no shorting or derivative position. You mentioned the pump and dump, then I feel like these are just the two different parts, because you make money by pump and dump, and then once you sell, it must be you already sell before your attack. And after you sell, then why do you still want to attack? I mean, so anyway, these are the two questions. So thank you.
Okay, so let's take these in order. First, Klaus, do you want to respond?
Yeah, I'm not 100% sure. I mean, the thing is, we have the data, and we base our estimates on that data we have. And even if we change the data, if we take a smaller sample, we get the same estimate. So we are dealing with a distribution that has no mean. And in one of these, we see that 10% of the whole Bitcoin supply has already been stolen, and 5% in one attack. So there's
what I meant is very simple, just to do like with different time period and redo the estimation. Can you do that? You must be able to do that. And
yes, sure,
difference?
sure. Sure. Yeah, this could be a possibility. That one, like a sample split test, right? That you just use a subsample and then check which attacks occurred in, let's say, the period from 2013 to 2016, right? Yeah.
Okay.
Thanks. Thank you.
Right. So proceeding to your question to myself, first of all, a really good question to highlight how money can actually be made from the attack without a short position in the coin. The idea is that a 51% attack on a proof of work cryptocurrency allows the attacker to double spend. The analog with conventional money would be forgery. So you basically create new coins out of existence, and you can transact with these coins, and you can, for example, pay for goods and services. But given the fact that cryptocurrency
Okay.
that much,
Yeah.
you can send them to your cryptocurrency exchange wallet, to your hot wallet, and sell them on the market. The
So-
idea is that the 51% attack becomes public knowledge, and the enthusiasts, the community becomes aware of it, not immediately, but after some time, depending on the verification time. So basically what you could do is you could double spend, get a whole lot of coins and sell them on the exchange. However, if the system, the community understands what's going on, the price will collapse and your profit will be massively limited. So to avoid that, for illiquid coins, you could stage a pump and dump scheme. So you could start pumping the price, then less rational, more herding like irrational traders, noise traders who are who have a higher propensity to herd. Basically, they would ride this wave of exuberance. They would start buying this coin as well, skyrocketing the price even higher. That can happen, and I can tell you more about how to arrange such attack theoretically in specialized cryptocurrency community chat. So there are exchanges that have those specialized chats where those attacks, pump and dump schemes, not necessarily attacks, are executed. So you combine it with that, it temporarily raises the price. So at the very top, you synchronize it with the attack and start selling the coins that you have accumulated and the ones that you have double spent, thus making money from both sources, basically. So they synergize quite well, the attack and the pump and dump scheme. And that's what I found with event studies. Does it make sense?
I do think it makes sense. So one follow-up, a little verification from you is that, do you see double spending in the ledger?
Yes, you can figure out whether it happens or not. And the MIT project that has already been mentioned today,
okay, good.
is
Thank you.
dedicated to the study.
Yeah, that would be useful just to the details. That's interesting. Good, thank you.
You could figure it out, but not absolutely immediately. But I think Joe could specify it to a greater extent, I guess.
Oh, yeah. I mean, you can look for evidence of double spends, and that's there. Yeah. So the MIT reorg project has some data I've looked at. I was just going to add one. I mean, there are some other proposed ways that you could make money besides having an explicit short position. Like there's a theory that if you hold a lot of when there's a fork that splits a community, like Bitcoin versus Bitcoin Cash, if you're able to tank the price of Bitcoin Cash, that might be reflected in a rise of the price of Bitcoin. So maybe that's like a bit of a bank shot, but at least it's a proposed way to profit off of distorting the price of one asset by hopefully raising another.
And obviously, as more derivatives on cryptocurrencies become available, then the opportunities to generate payoff structures that would offer attractive payoffs for the attackers, they just increase tremendously. So we could see even more attacks without pump and dump schemes, even given the fact that options or futures would become more prominent.
I will say, one opportunity for study, I think, if someone that I don't think has been done so far, is to look at, we've, Sava's work and others have shown that there's negative price impact on the coin that's being attacked. It's not clear to me if that leads to, a systemic loss of confidence and other assets also lose prices, or if that's reflected in a rise of similar tokens that aren't attacked. Maybe you have some data on that, Sava, but
my sample shows that it is the case. You can show that when other coins are attacked, on these days, Bitcoin loses around 1.5% on average, which is statistically significant. I just didn't report this result as it didn't kind of blend nicely with everything else I'm talking about. But yeah, it does pose a systemic threat, obviously. You could analyze whether it affects proof of stake versus proof of work. That's something I haven't done, but I presume that proof of work would tank and proof of stake will stay the same. This is something that can be easily verified, and I'll probably do it in a couple of days. So thanks for the idea.
oh yeah, great.
So I'm curious, there is a paper on the pump group with a list of events. Is there any overlap? Like, have you checked if the events in your list are also on their list, any of them?
Oh, actually, interesting consideration. Haven't seen their list of events, haven't meticulously looked through every single one, but I'll have a look and see.
Yeah, you may want to contact the authors, because the connection between them was not obvious until I heard your talk today, and now it makes a lot of sense to me.
Yeah, I mean, it was not obvious to me as well. The first two reasons I had in my head was the hash rate, rentable hash rate, and ASICs. But given the fact that event studies produce that robust result, this conclusion immediately popped to me. So I will contact the authors and see whether there is a link between the two. So thanks for pointing that out.
So any last questions before I announce our next event and we draw to a conclusion today? So if I may, I'm going to screen share for just a moment. We meet every 2 weeks, and our next event is April 1st. The host will be Maureen O'Hara from Cornell. The speaker is the famous Professor Sear. Many of you will recognize him as the whistleblower in the DAO Ethereum Classic event that took place 4 summers ago. So he'll be speaking, and as always, pre-register, but we hope to see many of you back in 2 weeks. Thank you all for joining today. Thanks especially to the 3 speakers for very interesting presentations, and I wish everyone a good day. Bye-bye.